Get rid of the ball and chain too many homeowners are dragging around, the mortgage. I know, paying off your mortgage early seems impossible, but it is completely doable, and people do it all the time. But how can you do it? And why would you want to put in the extra effort? Well, stick around to find out why.
What if everything you were told about paying off your home was designed to keep you in debt? Right now, millions of homeowners are making their monthly payments, believing they're building wealth and moving toward ownership. But the truth is far more frustrating. The average homeowner with a 30-year mortgage will hand over more than double what their house is actually worth. On a $200,000 loan at a typical interest rate, you're looking at paying back somewhere around $450,000 by the time you make that final payment. That's $250,000 in interest alone, money that goes straight into the bank's pocket while you spend 3 decades slowly chipping away at what you actually owe. And here's the part that should make you angry. Most of that interest gets collected in the first 15 years. During that time, your equity barely moves. You could pay faithfully for 10 years and still owe almost 90% of your original loan balance. The system isn't broken. It's working exactly as intended, just not in your favor. But there's a strategy that a small percentage of homeowners have figured out, one that completely flips this structure on its head. Some are using it to pay off their 30-year mortgages in 5 to 7 years. And once you understand how it works, you'll see why banks would never advertise it. Before we get into the method itself, you need to understand exactly why traditional mortgages are structured the way they are. It's called amortization, and it's the reason your early payments feel like throwing money into a black hole. Here's how it works. When you make your very first mortgage payment, roughly 80 to 90% of that money goes directly to interest. The bank gets paid first, always. The remaining 10 to 20% goes toward your principal, which is the only part that actually reduces what you owe. As years go by, this ratio slowly shifts. By year 20, more of your payment finally starts hitting the principal. But by then, you've already given the bank the lion's share of their profit. Let's put real numbers to this. Say your monthly payment is $1,500. In month 1, maybe $1,200 of that is pure interest. Only $300 actually chips away at your loan balance. You make that payment for 12 months, and you've handed over $18,000. But your principal has only dropped by around $4,000. This is why people joke about feeling like they're renting their home from the bank for the first decade. Because functionally, that's exactly what's happening. So what's the alternative? The strategy that's gaining attention is called velocity banking, and it centers around one financial tool that most homeowners either ignore or completely misunderstand: a home equity line of credit, also known as a HELOC. Now, before you tune out thinking this is some complicated Wall Street scheme, stay with me. Because once you see how the math works, you'll understand why this approach is so powerful. A HELOC operates fundamentally differently than your traditional mortgage. Your mortgage uses compound interest, calculated monthly, based on your outstanding balance. A HELOC uses simple interest, calculated daily, based on your average daily balance. That distinction might sound minor, but it changes the entire game. With a HELOC, every single day that your balance is lower, you're charged less interest. And this is where your income becomes a weapon. Here's how the strategy actually plays out in practice. Let's say you've been paying your mortgage for a few years and you currently owe $180,000. You've also built up some equity in your home, so you qualify for a HELOC with a $50,000 limit. The first move is to pull a chunk from that HELOC, let's say $10,000, and make a direct lump sum payment toward your mortgage principal. Not your regular payment, but an additional payment that hits the principal only. Your mortgage balance just dropped from $180,000 to $170,000. That's $10,000 of principal eliminated instantly, which means every future payment has less interest to fight through. Now, here's where it gets interesting. Instead of using a regular checking account, you redirect your income, your paychecks, any side income, everything, directly into the HELOC. The moment that money lands in the account, it reduces your HELOC balance. If you deposited $5,000 from your paycheck, your HELOC balance drops from $10,000 to $5,000 for that period of time. And because interest is calculated daily on the average balance, every day your money sits there, you're paying less interest. You still pay your bills from the HELOC. Groceries, utilities, gas, everything comes out of it. But the key is that your income hits first and stays parked there, lowering your balance before your expenses pull it back out. Over the course of a month, your average daily balance might be significantly lower than if you'd kept that money in a regular checking account where it does nothing. You're essentially making your cash work double duty, living your life and simultaneously attacking debt. As you pay down that initial $10,000 chunk, you repeat the cycle. Pull another chunk, slam it into the mortgage principal, and keep rolling. People executing this strategy aggressively have eliminated 30-year mortgages in 5 to 7 years, some even faster. But this is where things get controversial, and we need to address why this strategy has some serious critics. Financial heavyweights like Dave Ramsey have publicly spoken against velocity banking, calling it unnecessarily complicated and risky. And here's the thing, they're not entirely wrong. This method requires a level of discipline and financial margin that most people simply don't have. If you open a HELOC and start treating it like a free money credit card, dining out more, upgrading your car, buying things you don't need, you'll end up in a worse position than where you started. The HELOC is a financial tool, not a magic wand. It only works if your income consistently exceeds your expenses by a meaningful margin every single month. Let's be blunt about the numbers. If you're living paycheck to paycheck, spending everything you earn, velocity banking won't save you. You'll just be shuffling debt around while adding risk. This strategy requires that you have positive cash flow, money left over after all your bills are paid. Ideally, you want at least $1,500 to $2,000 per month of margin to make this approach worthwhile. Without that cushion, the math simply doesn't work in your favor. And there's another risk that almost nobody talks about until it's too late. Let's go back to 2008. When the housing market collapsed, banks panicked. Homeowners who had HELOCs woke up to find their credit lines frozen without warning. Some had their limits slashed from $50,000 down to almost nothing overnight. If you're mid-strategy, relying on that HELOC to manage your cash flow, and it suddenly disappears, you're in serious trouble. You might have just made a large chunk payment toward your mortgage, and now you have no liquid funds to cover emergencies. The banks that handed you that credit line can take it away whenever they feel the risk isn't worth it. On top of that, HELOCs typically come with variable interest rates. When rates are low, the strategy looks brilliant. But when rates climb, as they have dramatically in recent years, your HELOC becomes much more expensive to carry. A HELOC that cost you 4% a few years ago might cost you 9 or 10% today. Suddenly, the arbitrage between your mortgage rate and your HELOC rate shrinks, and in some cases disappears entirely. You need to run the numbers for your specific situation, not just assume it will work because someone online said it does. So, who does this strategy actually work for? Let's get specific. You need a stable, predictable income that comfortably exceeds your monthly expenses. You need the self-awareness and discipline to not inflate your lifestyle once you have access to a large credit line. You need to be comfortable managing your finances actively, tracking your balances, and understanding the mechanics of what you're doing. And you need some risk tolerance because you're leveraging debt to pay off debt, and that comes with exposure if things go sideways. For high earners with controlled spending and stable jobs, velocity banking can be a powerful accelerator. For people without those foundations, it can be a trap that makes everything worse. Now, if velocity banking sounds too complicated or too risky for your situation, there are simpler ways to accelerate your mortgage without taking on additional complexity. The easiest method that anyone can implement immediately is switching to bi-weekly payments instead of monthly. Here's why this works. By paying half your mortgage every 2 weeks, you end up making 26 half payments per year. That's the equivalent of 13 full monthly payments instead of 12. One extra payment every year might not sound dramatic, but it adds up significantly over time. That single extra payment annually can shave 7 to 8 years off a standard 30-year mortgage, with almost no extra effort or risk. Another straightforward approach is directing all extra money toward your principal. Tax refunds, work bonuses, income from a side hustle, every dollar you throw at the principal reduces your balance and the interest calculated on future payments. It's not flashy. There's no sophisticated financial engineering involved. But it works, and it carries zero additional risk beyond what you already have. Here's the reality check you need before trying any of these strategies. Velocity banking is mathematically sound. The numbers work on paper and in practice for the right people. But math and human behavior are two very different things. The banks aren't hiding this method because they're terrified of you figuring it out. They know that most people who attempt it lack the discipline to execute it properly. The ones who succeed were likely the type of people who would have paid off their mortgage early anyway through sheer determination. This strategy just gives them a faster vehicle to get there. The people who fail at velocity banking usually fail for predictable reasons. They see the HELOC balance drop and feel wealthy, then spend more. They don't maintain the cash flow margin required. They get hit with an unexpected expense and have no backup plan. Or they simply lose interest in actively managing the process and slip back into old habits. The strategy requires ongoing attention and discipline for years, not just a few motivated months. The real question isn't whether velocity banking works. It does, under the right circumstances. The real question is whether you're being honest with yourself about your spending habits, your income stability, and your discipline level. Because the fastest way to pay off your home isn't really about HELOCs or bi-weekly payments or any single trick. It's about spending less than you earn, consistently, for years, and directing everything extra toward eliminating your debt. That's the unsexy truth that no viral video wants to tell you. There's no secret the banks are hiding. There's no magic hack that bypasses the fundamentals. The people who pay off their homes early all share one thing in common. They made it a priority and they sacrificed for it. Whether they used velocity banking, bi-weekly payments, or just aggressive principal contributions, the underlying engine was always the same: discipline, margin, and consistency over time. That's what actually sets people free. The strategy you choose is just the vehicle. And now you know enough to pick the right one for your situation.